Come on up. I think RVK's going first. Come on up, Jim.
Where would you like me, Mr. Chair?
Anywhere, take any seats you want. Actually, why don't you come sit up here?
You guys have too difficult a job.
Welcome.
Thank you. I know you are short on time. You're running a little late, so I'm prepared, Mr. Chair and members of the committee, to be pretty focused as long as you want me to.
That'd be fine.
And I do want to say that while I'm presenting, I'm representing a large team of RVK professionals that we put on this assignment. It was tight time frame, and I'm extremely proud, quite frankly, of the work that our team did. The senior members of the team are listed on page 5 of the presentation. I hope Karen is somewhere around here manipulating the screen. That would be great. I hope you all have copies of it. I won't go into all the details. Introduce myself. I'm the president emeritus, having served as president of RVK for close to 20 years. Before that, I was on Wall Street. I've been a CIO in the plan sponsor world. I've been an executive director of a state pension system. I've been an investment banker. I've sat on corporate boards. I've been a trustee on corporate and public pension and savings plans. So I've had almost every job in institutional investing that you can imagine. And I have the scars and the humility to prove it. So with that, I'm going to work off page 6. It is a very compact executive summary of the key points of what is a very large and very detailed report. And that report, as well as this presentation, actually follows the scope of work that the LSO presented to us in excruciating detail. But the key things that I think I want you to take away from the work that we did are really the ones that I'll discuss on page 6. So the first point I want to make, and that's number 1, is that looking at performance compensation and looking at benchmarks, they are definitely connected. But I want to make sure that I deliver the point that benchmarks do not serve performance compensation. That would be the tail wagging the dog. Benchmarks are meant to illustrate as closely as possible the performance of the portfolio, and in terms of not only its performance, but what drives the performance and allows the fiduciaries and the investment staff to understand why and to have some sense of what it might do. I liken the performance report with benchmarks as the same thing as when I've run corporations where I had an MIS system that told me how the company was doing, literally on almost a daily basis. With respect to WRS, the performance report, including the benchmarks that are in it, are very much like their management information system because they're running a multi-billion-dollar business for the state. So the upshot of that is that if there are any concerns that you have or improvements that you think you might want to pursue with the performance compensation plan, the wrong thing to do in our judgment is to try to tinker with benchmarks to make it happen. The right thing to do is to look at the structure of the performance compensation plan itself, the formulas, the cutoffs, the caps, the applicability, and so on. Those are the things that where if you have concerns or opportunities for improvement, they're more likely to lie there. Key point, I think, that we want to make. Please.
1 second, Jim.
Help me understand, Jim, if you would. So I'm excited because I got to sit through this yesterday. And so I've been stewing on this. When you say don't mess with the benchmarks, what do you mean by that? Because I think, is it for them to decide and we should stay away?
No. I don't. I don't say don't mess with the benchmarks. I'm saying that if you have concerns or think you have improvements in mind for performance compensation, changing the benchmarks is not the best way to make it happen.
Thank you.
Changing the structure of the performance compensation plan is the best way. No, in fact, as you know from yesterday, our report details a fair number of places where, were we the general consultant to WRS defined benefit plan, we would recommend some different benchmarks. But these are all in the context of differences of opinion between ourselves, maybe the investment staff, maybe the board's general consultant currently. These are all the sort of inside baseball, if you will. And I likened it yesterday to two lawyers arguing over which is the best case citation to make in a pleading that would be most effective, or two structural engineers saying, no, at this site, a cantilever bridge would be better. No, and the other engineer says, no, I think a suspension bridge would be better. All of these are perfectly appropriate things to do to build a bridge or to file a pleading. But there are always differences of opinion. The question is, do they matter to the outcomes that you've seen to date in the performance compensation plan, or are they likely to in the future? We think the answer is no. They're not material, but they're changes that we would recommend were we the consultant. And I know from yesterday when the CIO and the executive director followed my testimony, and you heard that yesterday, Representative Larson, that they will take a look, they present to the board these ideas. And this is not something that we think, oh my gosh, you just have to do these things, but we think it's a good discussion to have because benchmarks are important, and I'll talk about that in a moment. The second thing is the LSO scope of work asked us to talk about the governance process by which benchmarks were created and applied for the WRS. And that's point number two. We, as in the course of this project, we interviewed an enormous number of people at WRS, even at the State Treasurer's Fund, at the highest levels of state government, all through state government, the Investment Advisory Committee, all across the board. And we followed the process by which benchmarks are decided on by the WRS board. And our conclusion is that there is a robust multi-party process for benchmark setting and review. By robust, I mean that there's a discussion. By robust, I mean that, and by multi-party, and this is an important point, there are now 5 parties involved in the discussion for benchmarks for WRS. There's the staff, there's the board, there's the board's general consultant, there's the investment advisory committee, and now there's us. And so only one of those parties actually has skin in the performance compensation game. So 4 of the 5 entities speaking to benchmarks have no financial benefit one way or the other. And I think you should take some comfort that, because again, the LSO asked us about the whether or not the governance process by which benchmarks were selected seemed to be robust, and the answer is we think it is. The points 3, 4, 5, and 6 really roll together. As I said, we have a number of tweaks that we would recommend if we were the general consultant, but we will say that all of the benchmarks that are used by the approved by the WRS board and applied by the staff are institutional quality. You will recognize them if you were to go to any state, any municipal pension plan. In fact, any institutional investment portfolio, you would recognize benchmarks. Now, would they all be the same? Obviously not, because we have a couple of that we would move in one direction versus the way the WRS board has. But none of them are head scratchers like, where did this come from? I mean, we've never seen this before. And I think that that's important to mention. The other thing is that we do have a couple suggestions, and I won't get into it because it truly is geekland. about the way underlying asset class exposures are rolled up into essentially what are called asset class composites. But again, that's definitely inside baseball. Any questions so far? I'm all the way through 6. I'm rolling, Mr. Chair. The other key thing about page 7 is that our team did a number of calculations using various benchmarks and approaches. And because the WRS board has chosen to hinge the performance bonus pool, if you will, the incentive compensation pool, hinging it on the total fund basis, the individual benchmarks down in the asset classes have very little effect at the top of the chain, because they roll up through multi-sub-asset classes into asset class composites. And what that means is that, and we think it's a good thing. In fact, we do it at our own firm. We have a single bonus pool that hinges on the performance of our company. And so we are inclined, and we observe that this is more often the case. It's not the same with the State Treasurer's Fund, and they have a reasoned approach to why they do it differently than WRS, and you can discuss that with them. But what that means is that we feel that all of the changes that we might suggest that at least be considered, we don't think that they would have altered both the past compensation plan outcomes, nor necessarily the future ones as well, with one exception, which I'll talk about in a minute. Now, if WRS had not decided to hinge the performance pool on total return of the total fund, and did it more like part of what the State Treasurer's Fund did, we might have some different opinions about this. But I think it's important to note that the way that they've implemented it has made the performance plan very much hinge on total fund returns and much less on individual asset classes, where benchmarks largely reside and can make a more important difference. Another question that came up, and I'm on number 8 on page 6 now, which is it unusual to see exposures in particular mandates? We call mandates, those are the things that are handed out to managers. Sometimes they're handled inside staff that reside in asset or sub-asset classes. It is not uncommon to allow a manager a very specified amount of leeway to go outside the benchmark universe, and that is typically negotiated in what's called the IMA. And then it should be monitored, and it should be consistent with what the board allows in its investment policy. With one exception, we found this to be true at WRS. And the one exception is a single sub-asset class called collateralized loan obligations. Think of it as a form of packaged fixed income. And again, I'm relying on what the executive director and the CIO from WRS said yesterday, that's something that they're going to reconsider to make sure that there is that one misalignment between what's stated in the investment policy, that is the board's authority granted to the staff to have these exposures, and an announcement, by the way, to the outside world, that is consistent with what is actually happening at the mandate level. But I would hasten to say that the CLO allocation, even though there is a misalignment at the moment between the IPS and what the portfolio actually has in its exposures, is not material in our judgment to either the historical outcomes of the fund or the plan, the PCP plan, nor is it likely to in the future. But we think it's something that should be corrected. I would call it very good housekeeping. As I said before on number 9, and I won't go into this in depth, but because I've already stated the case, but number 9 really reiterates what I said at the beginning, that either if you decide that you want to look into the PCP plan to either look for improvements or to address a concern that you might have, the response, the answers almost always, in fact, maybe always, lie in the structure of the plan itself, not somewhere else. So long as...
Just let me follow up with what you're saying, though. So if, there's a value in collateralized loan obligations, where would you place it? And what would you measure it to?
Well, I'm sorry, where is the value in?
Well, for the collateralized loan obligations, CLOs, what category would you put it in, and what is the risk involved in it as compared to the Core Plus where it's currently located?
A couple of things. I appreciate Mr. Chair, the clarification of the question. CLOs are very commonly used in institutional portfolios. They lie within the fixed income category. They are a special type of fixed income in terms of not being individual bonds, but clusters of bonds that are sold. And their risk can vary because sometimes a CLO can be sliced in terms of if there is a bankruptcy somewhere in the bonds that are held in this package, who gets their money first? And so that it depends. So I don't have a good answer for you because I'd have to look into the particular slices of the CLOs that a WRS might own. But again, they're not typically known as unusually risky unless they're highly concentrated with a lot of money in the lowest credit tiers. And sometimes, by the way, they're not tiered. Sometimes they're just bought as a package of bonds. So I don't have a good answer for you, but I can tell you that it's not unusual to see CLOs in a portfolio of the size and multi-asset class nature of WRS.
So that doesn't really help me in terms of how you do the benchmark to know, you just allocate it in your fixed income portfolio as part of the, and Sam, you can answer that when you come back up. So, go ahead.
So, Jim, we
can let Sam answer that first.
Well, and yeah, and go ahead. So I hope this is relevant because I kind of fished a little bit when this came up yesterday, but I think the conversation is what do you allow to be considered for benchmarks? And if it's in the integrated, what do we call that thing? The investment policy statement, okay. If it's outside the investment policy statement, then that may need to be adjusted. Is that a fair?
Yeah, I'll let Sam speak for in a moment, but there are two questions on the table. One is, should there be a good alignment between what the board in its investment policy statement says and what's in the portfolio? Different question, and that's where the misalignment is. Then a different question is, can CLOs be benchmarked, and how should they be benchmarked? And by the way, is it material to the total fund return that drives, that's an important driver of the compensation plan?
But also the definition of material is significant. We're not talking about money. We're talking about just the impact on beating your benchmarks and the likelihood of beating those benchmarks.
Fair enough. Sam, did you have something you wanted to weigh in?
Yeah, sure. Sam Masudi, CIO of Wyoming Retirement System. Thank you, Mr. Chairman. So as Jim was saying, there are different quality levels of CLOs. There's everything from AAA to very risky BB, for instance. Those are the credit ratings. So the CLO exposure we have is all through a manager, PIMCO, and it's all AAA. So the Core Plus subcategory within fixed income, Core Plus tends to be fixed income that has credit risk. So we've got a government category, we've got Core Plus, and we've got opportunistic, which is below investment grade. And so the CLO exposure we have is AAA. It's very low duration, so it improves the overall quality of Core Plus. And so it belongs in Core Plus. I think the issue is we just need to expand the definition in the IPS to make it more clear that that's in the universe of investments.
I hope that's consistent with what I said.
Yeah, absolutely, yeah, it really is, yeah. So it's AAA, it's the least risk you can have for fixed income except for US Treasuries.
And again, the reason is because under the rules of the CLO package, if there is money that's due, they are first in line. The BBB players are the last in line. So, and that's, again, not uncommon to have the BB levels held by very risk-oriented investors, hedge funds, for example, other
Sam, how
types.
much do you have in your Core Plus portfolio?
I think it's about, I want to say about 5%, and I think roughly half of that is CLOs. So generally, CLOs are not going to perform well as the rest of the Core Plus portfolio because it has more risk, so there's a higher return, and it has more interest rate risk.
Okay,
Okay. Thank you, Sam.
please proceed.
Any other questions on this? Otherwise, I'm going to move to number 10, which is kind of the corollary of what I've been talking about the structure of the PCP plan. There is no accepted consensus whatsoever about the optimal structure for an incentive compensation plan for investment professionals. They are very common and becoming increasingly common, whereas they weren't so much 10 plus years ago in the public fund sector. And for all the reasons I think that this body decided to authorize such a program here in Wyoming. But these vary, and what you find when you dig into the details of a performance compensation plan is that there are many, many trade-offs and sometimes unanticipated consequences. I will mention one after I'm through with the executive summary, just to give you an example of one that may or may not be an unintended consequence of the current structure of your plan. But should you decide to reopen the plan structure and re-examine it, I would encourage you to not think that there is an optimal one, but think in terms of if we do more of this, maybe we introduce less of that. Because there are always trade-offs and always look for unintended consequences, because when you present incentives to anybody, you can affect their behavior. And in the current structure, you've done a good job, I think. This body, in terms of the cap that you've put on it, so that there's a limitation on the incentive to take more risk, but also you've put people in charge of the program that aren't part of the incentive compensation plan. The final deciders of what gets invested and the asset allocation and the benchmarks are not the staff, but they are the fiduciaries and the fiduciary board. So I think that you came up with a good program to begin with, but because there is no consensus, there's always room to at least think about changes that might improve, with the knowledge that you don't want to do anything that inadvertently actually makes it worse. That's the point on number 10. Point on number 11 is that, I mentioned this before, that the movement or the decision by the WRS board to hinge the performance compensation plan on total fund returns, we think is a wise one. And we see no conflict between the way that the WRS has implemented it and the statute, which we did. We're not attorneys, but we did look at the statute authorizing the program and its background, and we talked to some of its authors, and we think that the board's implementation seems perfectly reasonable, if not maybe ideal, given the structure of the program. One of the interesting things that came up, because when we were asked to do this assignment, we wondered whether or not there were deep and abiding concerns about problems in the PCP plan, but we interviewed literally several dozen key individuals throughout the state. And even those that had suggestions about you should look into this, you should look into that, to a person, they said that the PCP, which this body authorized, has been a real plus and has achieved its objectives at least to date, meaning reduced turnover, improved recruiting, and a higher quality investment staff that is more stable and better able to pursue returns. And I've often told people that anybody that thinks that investing billions of dollars is easy are people that have never had to do it. There
I'd like
was
the
one.
opportunity, though.
I'm sorry.
I'd like to have the opportunity.
Be careful what you ask for, Mr. Chair. Point number 13 is we did get one particular piece of feedback that asked us to think about the extension of the program that you authorized into non-investment staff, support staff, operational staff, and so on. We don't have a strong opinion about that. We were not asked to particularly opine on that. It is not altogether common for that to happen, but it has on some occasions. But it was only one individual, and it was definitely not a consensus point that was made in our many interviews with Wyoming officials and interested parties. I guess the last one, of course, is that if you do decide to at least consider any structural revisions in the PCP, there's no argument for not doing that. I think the only one that you want to do, the only thing that you want to keep in mind is in the spirit of its ultimate objectives, which is retention of the best investment talent you can attract and the recruitment of it, you don't want to create a sense of uncertainty that's unintended about how you might compensate the handful of highly skilled individuals that you want in place managing the biggest pots of money in the state of Wyoming. So those are the key takeaways from our report. I won't go into the why benchmarks are so important. I think that should be obvious. But I will say this, if you turn to page 9 and 10, what you will find here is that there is a sense from the outside, if you're not part of the investment world, that surely for every type of investment, there must be a clear and unambiguous and perfect benchmark for it. And the answer is that's not the case. At least that's not the case for some of the key investment exposures that could be in a portfolio of the size of a WRS. And the reason is that I liken it to the advice that we get from our cybersecurity professional who makes my life miserable, but for a good purpose. And that is strong passwords versus weak passwords. In the world of benchmarks, you prefer strong benchmarks versus weak benchmarks. But just like no password is unwise, no benchmark is unwise. But getting a strong benchmark is not always as easy as it seems. And that's why there are some differences inside baseball between, say, ourselves, other consultants, and sometimes even some of our clients and client staff. But you have to give your best advice, otherwise you're not being a good co-fiduciary. But page 10, I will just visually say, in some categories, there are certain aspects of what is defined by the CFA Institute as being a perfectly strong benchmark that can't be in reality, in the real world, achieved. And so what that means is that you always have to work with second best. And I'll take one example, private equity. Maybe the single most difficult category to benchmark well. And it is one of the areas in our report where we suggested a different benchmark, or at least a supplementary benchmark be used that is more market-oriented versus more peer-oriented. But what you see here is that you've got two red X's, meaning that it's always going to have some ambiguity, and it's never going to be investable, which are the hallmarks of a strong benchmark, like a strong password. So I use that just as an example.
You don't see that 9 and 10 he's talking.
And that example is actually noted in your presentation on page 14. I won't go into it because that would take us deep into Geekville, and it's where I like to live, but I don't think it's where you like to live. The one thing that I will say that you should consider is continuing to smooth the results and the outcomes of the PCP plan over time. Now that it is starting to mature, two things are on the table. One is the 3-year look back. Should it be 5-year look back? That's one. And the other is, should you use a geometric return versus an arithmetic return? Now that sounds geeky, but let me explain both of them. In the pursuit of the ultimate objectives of this program, which is retention of staff, recruitment of the best staff you can find when you need to, you don't want a program that has incentive compensation that has big cliffs and big changes that could go way down one year, way up one year. I lived for almost 20 years in that system on Wall Street, and it was a nightmare. It's not something that was very much fun. And it itself led to turnover, by the way. It was an extreme form of what I call cliff incentive compensation. The more you can smooth things out and still reward the investment team, the more likely it is that the investment team will say, I'm being judged on a record that is not so short that I'm subject to too many ups and downs in the compensation that may or may not be the result of any bad investment decisions. It could be market conditions, for example. So that's one thing to consider should you go into this. The second thing, which we feel kind of strongly about, is that now that you're building a track record in the PCP plan, one of the things that you started out doing was using arithmetic average. That is, very simply said, you took 3 years, in the case of WRS, total fund returns, divided it by 3, and that's what it was. Nothing terribly wrong with that, except for one thing. That's not how investment returns compound over periods. They compound geometrically, and what that means is that it's a return stream that takes into account ups and downs in a more risk-oriented fashion. Compound returns are the best practice standard for all of investing, not arithmetic returns. So it might be something for you to consider. It might be something for WRS to consider as well, because their returns, as they apply to, for example, meeting their actuarial benchmark, are compound returns. They're not arithmetic returns. So I throw that out as an example of a structural issue that we came across, and combined it with the notion of maybe extending the period, because it may further the goals of the program itself, which is retention and recruitment. The other thing that's interesting about this geometric aspect, and now I will go down into Geekville, is we ran 10,000 trials of the PCP program and the returns to ask the question, could there ever be a case where the arithmetic excess return was positive and therefore triggered some sort of payoff, but the compound return was negative, which is not good because that's what you pay benefits with? And the answer is there is. Exceedingly rare, but it is possible. And you see that on page 19, we just plotted of the 10,000. This looks like it happens often, but remember, these dots sit in a universe of 10,000 runs. So I think that it gives further justification for at least considering geometric returns versus arithmetic returns in the, as the trigger or as the driver in the PCP plan.
Hey, one second. Go ahead, Clark.
Oh, yeah, Jim, thank you, Mr. Chairman. A couple of questions. One is you mentioned that right now the board has adopted a policy of making performance-based compensation based upon total fund return. Can you give us an example of what difference that makes? And let me add the other bigger question, which is the nub of my real question. It seems like finding a benchmark for a given asset class is not very difficult. If, treasuries are gonna, your expected return is gonna be X, and so if your fund manager outperforms, then they get a bonus, right? Or if you have and that might be one number, if your asset class is, say, an exchange traded fund that follows the S&P 500, that would give you a different, probably higher number. And so to outperform, you'd have to achieve an even better return. My question is this: what is your recommendation to us, if anything, of how we deal with the problem of what if a fund manager says that their fund has an alpha of, X, and it has a certain risk profile, say treasuries, but they're in fact in their actual fund, they don't just have something like treasuries, they've also got some collateralized debt obligations or something far risky that essentially spikes the return to make it far, far more likely that they will exceed the benchmark. What is there a way, how do you guard against that temptation? Because I would think for any fund manager, the temptation to do that would have to be pretty strong.
Wow, that's multiple questions. Thank you very much for those questions, but I need to unpack them one at a time. So let me deal with one question first. Is it easier to benchmark total fund or individual asset classes versus the total fund? For some asset classes, it is. For many asset classes, it's not. You may recall the chart that I just showed you earlier. Those are individual asset classes. They fail the CFA test of meeting a super strong benchmark capability. And you saw those red X's, and simply because the nature of the beast doesn't allow an unambiguous benchmark or an investable benchmark. So, and also inside a multi-asset class portfolio, you can look at an asset class. It may have anywhere from 1 to sometimes 6 or 8 sub-asset classes of various types still in the category mixed in. So I would respectfully say, in many cases, it's not any easier in the case of asset classes, particularly for large multi-asset class portfolios like the ones in Wyoming, to benchmark them. And the good thing about the total fund is that if you have benchmark mismatches simply because they're impossible to match perfectly per the CFA requirements, those tend to wash out. The law of large numbers tends to wash out the effect of those. That's asset class versus total fund. Your second question is, how can WRS be confident that their managers are not cheating? Well, I think there's 2 things. One is, this is a very common, well, 3 things. One is data integrity. So for example, you should always have a general consultant. Now that's a self-serving comment because I lead a general consulting firm. But the reason that general consultants are almost universally used is that they are the watchdogs between the custody bank and the manager to make sure that the data has high integrity. We have no reason to believe that the data used by WRS does not lack integrity. The second thing is, I mentioned earlier that every manager would love to do something to make themselves look good. There's no question about that. But they also have to operate inside what's called an IMA, Investment Management Agreement, which specifies precisely what they're allowed to invest in, and sometimes very specifically how much they're allowed to invest in it. And that ties back to the allowable types of investment that are in the investment policy. I would be shocked. We did not, as a matter of this project, pull all the IMAs, but I'd be very shocked if that's what you wouldn't find. But I have to tip my hat to WRS. They go one step further. at the total fund level. And that is, and very few funds do this, but it is an interesting approach. And that is that they've contracted with an overlay body to look down into all the asset classes and ask the question, forget what category it is, forget what the mandate says it is, forget what asset class they say it belongs to. Instead, roll every security up into a single portfolio and ask the question, how much equity do I have? How much fixed income do I have? And that is done on a highly frequent basis at WRS. I have to give them credit for that. And and it goes to the board. In fact, I have a copy of one of the reports here that we pulled so we could look at it. So there are multiple layers in answer to your question about how data integrity and potential manager misbehavior is monitored. There's also, and this isn't in every general consultant's contract, but is in many of ours, which is called a compliance check, which means that we do for every manager, we do a look through at the securities level and ask the question, are they in compliance with the IMA? Now, it's an extra level of performance reporting and analytics, but some clients are willing to pay for us to do it for precisely the reasons that I believe lie behind the question. So I hope that's responsive. I'm happy to try to deal with it further.
Any follow-up?
Mr. Chairman, just one follow-up question. Jim, this may be a slightly separate topic. You said, I think you were talking about the collateralized debt obligations, and you said there was something that you would want to fix, use the word fix. And so what is your recommendation? What is it that needs to be fixed?
It's not a difficult fix at all. It's simply say there is an exposure in the portfolio that is not mentioned as an authorized type of investment exposure in the investment policy. We don't think that, there's no reason to think that it's deliberate, could have been just inadvertent, but we think that it's good housekeeping for them to be aligned. So the easiest fix is simply for the WIS board to sit down and say, if we want to continue to invest in CLOs, we have to formally say in our investment policy statement that yes, this is an acceptable type of investment. And they may specify, as Sam indicated, that that the limitation is to the AAA tranche, the by far the least risky type of CLO. That's totally at the behest of the WRS board, but that's the fix.
Well, let me just follow up on that question. So as I understand it, Core Plus is a Bloomberg US aggregate index. Do AAA rated CLOs fit within the US aggregate index as a benchmark?
No, they're part of the Core Plus structure. So, and so you would typically see them. They would be benchmarked. They would be mentioned in the IPS. But I think the answer is that one of the things that we like to do is to do custom asset class benchmarks that are roll-ups of the benchmarks of the exposures underneath. I mentioned earlier about roll-ups. This is commonly done, but it has its downside too, which means that one can't be too prescriptive about it because from a tactical and a strategic point of view, the investment staff and the board may say, well, CLOs have been great so far, but we want to take them to zero right now. So what that means is that the benchmark would constantly be changing as the weight goes from something to nothing or nothing to something. So there's no free lunches here, but that's the the way that it's typically handled.
Okay.
So I mentioned geometric. I'm going to wind up here very, very shortly.
So Sam, when you come up and you just comment on the geometric versus the compound. Go ahead.
And let's see. The other thing is that I would say, and it goes back to the structure of the investment program. Again, maybe I'm colored by my experience, but in the world of investment banking, and I ran an investment bank for a couple of years. For the managing directors, their annual compensation, about something on the order of anywhere from 70 to sometimes 90% of it was incentive compensation. And it could vary widely. And it was very traumatic sometimes in some years, and sometimes it was unbelievably good. But the point here is that it's not the way to create a stable professional services environment, in my humble opinion. And so one of the things that you always have to look at, and that I think you did when you created the program, was the balance between salary and incentive compensation. And there is no magic algorithm that says, oh, 50-50 is the best, or 70-30 is the best, or 30-70 is the best. But it bears thinking about, because it does, or it can have a profound effect on your ultimate goals, which is retention and recruitment. Different types of candidates look at this mix of salary and incentive compensation in different ways and put different values on them.
Well, I think it would be helpful, the fact is that this Appropriations Committee is going to be entirely different in 3 months. And so the new committee is going to have to get re-educated and understand the value of incentive compensation. So going back to just the general terms, I mean, does it really work? And what happens if you don't have it?
Well, I believe that it really works. It's one of the reasons that it is spreading in the investment world, and in the asset management world, it has been almost universal for decades. And also on Wall Street, where I worked. I guess I have to speak my own book here. When I first became president, along with Becky Gratzinger, whom I think you know, of our own firm, we introduced incentive compensation. So I have to be consistent with what I've actually done and answer your question in the affirmative, but I do believe in it. But it is a tricky thing to do well, as I've said frequently this morning. So I'll stop there.
And how does our in terms of dollars, how do we compare to others? And you talked about a little bit yesterday, so I just want you to kind of regurgitate that. And
well, we did not do a detailed analysis of your compensation levels as they have emerged over the last 3 years, with a large universe of what we think are peer-like institutions. But I will say that I think your compensation, particularly given that your staff is working not in a financial capital in the U.S., has made significant strides to be competitive. And I think that you would see, and I believe that the executive director and the CIO would say, that it has made a material difference in the retention of your best investment talent and the recruitment of investment talent to the state. And as I said, this is true of many states. We're the consultant to places like Vermont and other states where the pension pool, Montana is another example, where the pension pool and the other pools of money, such as the state treasurer's fund, are literally the biggest financial businesses in the state. And it just strikes me as common sense, as a businessman myself, that you would not want them tended by anything less than the best that you could bring into the state that sits reasonably with you in terms of compensation. You appear to have had, in the early stages of your program, success.
And so I just want to go to the next step. The reason that we want retention and consistency is because ultimately, if you have turnover and all that kind of things, your performance deteriorates, at least, and at least that's my understanding, and I just want you to go down to that next step.
Again, I've been in this business for over 40 years. If you showed me, and I knew nothing else about them, 2 funds, and I looked at their history, and one had constant turnover at the staff level, and another had very little turnover, I would bet that the results for the little turnover would be better. It's not a guarantee, because there's also turnover at the fiduciary level. Turnover at the fiduciary level can be problematic as well. But that's not the subject of the PCP. And I would say that there's a particular pension plan, which I won't mention right now, which I happen to be the consultant to the state legislature in this state, in this particular state. And they have a very good investment track record. I have to report on a periodic basis throughout the year to their committee, essentially, that oversees all of the funds in their state. And they have recently lost their CIO, their executive director, their deputy director, their head of asset allocation, their compliance officer, all in the space of just a couple of months. Their CFO as well. I am not optimistic that their good investment track record can survive that much turnover. So when you look at WRS or you look at the State Treasurer's Fund, if recruitment has been good, you don't want to have to do it again, because every time you do it, you have to roll the dice. So if you feel like you've got a good staff, retention becomes critically important. And these funds, I think, I would argue, have all the earmarks of being critically important to the state. So I'll stop there.
Well, I think history in Wyoming is a valuable tool. If you go back to the late 90s and the early 2000s, we were constantly in the lowest quartile, and we had significant turnover, and at least 3 different times the legislature had to bail out the fund because we were trajectorying in the wrong direction. And all that has changed now that we have professional leadership and quality investment advisors working for us.
I'm aware of the history. As you know, we've done a lot of work for this state for close to 20 years. You are dead on right about that history.
Okay. Anything else, or proceed? You there?
I am complete unless you have other questions, and I'm very sensitive to your time. You've already put in a full day's work and then some, so I appreciate it.
Other questions for Jim? Okay. Sam, come on up.
Mr. Kojer,
And Dave.
thanks for holding down the fort
go ahead. I'm
for
sorry
me.
about
Well, no, I just go
Go
ahead
ahead.
and carry it out on Makita here. I appreciate you holding down the fort for me. I had an appointment, and
No-
thank
no
you very
worries.
much.
Thank you, Mr. Chairman. You had asked about the difference between the geometric return and the arithmetic return, and right now it's arithmetic. Our performance is calculated by Makita using geometric treasuries as to, that's sort of the standard, and so ideally those would match, so we'd be in favor of that change. And I think typically the difference in the 2 calculations will be a few hundredths of a percent, pretty minor, but it's just good to have the consistency.
Dave?
Thank you, Mr. Chairman. David Swindell, Executive Director of the Wyoming Retirement System. Just to follow, yeah, we concur with going with geometric. We always preferred that, was a concession to other stakeholders when the plan was devised. But we can fix that. I just want to remind folks of just a couple of things about the performance compensation program. I want to thank, in particular, both the CATFIN committee and this committee for establishing the program. It's been very successful. The overall conclusions, as Jim mentioned, was that the board's implementation of the performance compensation program and the legislation has been thoughtful, and it's aligned with the decision-making process at WRS, and that the many people that they interviewed share a consensus view that it has to date met its objectives. And the objectives are exactly what you profess, Mr. Chairman, the retention and recruiting retention of quality staff to generate better returns than we had in the past. Your recount of history is exactly dead on. I'm happy to report in our latest report to you that since the PCP's inception in 2019, the team has added $629 million in value add over a median performance, over the benchmark. And of course, as you mentioned, we didn't always achieve median performance. We were bottom quartile, in some cases bottom decile against our peers. Today, we're top decile. The difference is huge, and it makes a huge difference for the program. So thank you very much. My last comment would be, I would like this committee, as I mentioned yesterday, we also have another relationship with RVK. It had nothing to do with this consulting report, but we do contract with RVK to be the board's consultant on the 457 deferred compensation program. It's another $1 billion operation we have, and they do an excellent job, as they did on this report. So thanks, Jim, for the work of your firm there. With that, I think Sam and I are ready to stand for questions.
Any questions for Sam? Any comments, Sam? You mentioned a little bit about turnover, I think, yesterday.
Yeah, right. So in the past 5 years, we've only had one analyst leave who went to the university. So nice to keep it in the state. But yeah, I think I can safely say if it weren't for this program, we would have had a lot of turnover over the last 5 years. It's really been absolutely critical to our success. I can't express enough how much how grateful we are for this. So it's been a very effective program, and I think that we produced very high return on investment. So I hope everybody's happy with the results.
Mr. Chairman, I'd also like to mention that Sam has been with us since 2013. So he passed more than 1 decade of service to the state now in his 11th years. So that's part of the stability is at the chief investment officer level. I couldn't thank Sam for not only being the quality investor he is, but a quality person.
Well, I noticed on your recent handout, or your flyer that you sent out to employees, talking about the legislator's actions in having the automatic adjustments to the renews every 2 years, you're essentially for contributions to the funds in order to ensure that they're sound and reaching 110%, basically.
Mm-hmm.
So thanks for the thank you to the legislature.
Yeah, I think it's been a good partnership, Mr. Chairman. I think the one other comment that was made as to whether or not we should extend this program to some of the non-investment professionals that are in a support administrative role. One of the board has always been a little reluctant to go there. The board's philosophy has been to focus the performance compensation on the investment professionals that make the decisions rather than the administrative professionals that implement the decisions or report on them. However, we know that there's sometimes been a preference to do that. The additional support that the legislature authorized in the last session to give some back office support directly to SAM enables us to consider that better in the future because we're better able to segregate the duties now. The investment accounting function is removed from SAM's purview, and some of the administrative tasks are now focused in the investment team with that support staff. So if we want to go there, we're better able to handle that if stakeholders so desire.
Well, and we've had that conversation every year. And I would only say that be careful what you ask for, because it's a good way to get your hand chopped off.
Yes.
It's just, I mean, the idea that a secretary or an accountant in your office will make performance comp compared to any other state employee, I just don't think it's gonna, politically, I think it would be suicide.
I think the board also realizes that. Thank you very much, though. Once again, I just want to thank this
Not that we
committee for
wouldn't
all the
love to
support.
do it. Okay, anything else for Sam? Okay. Thank you very much. I don't see any hands up, so, okay. Appreciate it. Makita is up next, unless anyone else have any public comment? Dave, go ahead.
Mr. Chairman,
Please.
if I may, I'd like to mention that the state of Wyoming has just graduated, I believe, 12 new fire folks and 13 new fire folks in a ceremony held down in the auditorium over the lunch hour today. And one of the fine gentlemen training those folks is my youngest son, Ty. He's also a firefighter for the city of Cheyenne. And as an added bonus on the upcoming election here for the ballot of county commissioner, we have 2 names on the ballot, and he is one of the 2 names on the ballot. So we're hoping for good things. But anyway, my youngest son, Ty. Well done.
Hey, Ted. Okay, Makita, come on up. Welcome. How are you?
Thank you. Good to see you all. Can everyone hear me okay?
Yes.
Great. Thank you so much, Mr. Chair, members of the committee. I'm Mika Malone, a consultant with Makita Investment Group. I'm joined by a robust team of professionals from Makita who will be presenting our materials to you today. Primarily speaking will be myself, Sue Brumbaugh, and Nick Erickson. We also are supported by several other team members, including Owen Lingenfelder and Inwoo Huang. They're also online in case there are questions, but I did want to check in before we get started just in terms of timing. I know you're a bit behind schedule. We had planned our remarks to be about 20 minutes or so, leaving 10 for questions, but if you'd like us to adapt that timing, please let me know.
I think we're fine. I liked your backdrop. Yep, better yesterday, though.
Yeah. the stairs of the Makita Boston office, yes, it's a better background than my real office wall here. So, well, appreciate getting to see some of you again today, and again for all of your time. This project was really a lot of fun to work on. I appreciated hearing our colleagues at RVK providing their perspective on the WRS plan. This is Makita's opportunity to share our review of the State Treasurer's Office program and fund. I'll just start by saying that overall, our conclusions, much like you heard just a little while ago, were that the processes, the structure in place, the performance as reported, and the incentive compensation program as currently utilized have resulted in accurately stated numbers, incentive compensation that's resulted in strong retention, and we don't have any reason to believe that any of the numbers as reported are incorrect in any meaningful way or provided outcomes that could have been manipulated. So just starting there, what we'll do is ask Karen again if she's available to share our deck, and we'll walk through a number of slides to just support the various components of the scope of work that we provided for this project. And really my comments will begin on the executive summary on page 5. I did want to highlight that when we conducted this review, it was important that we gathered a lot of data. So we had to gather data from the State Treasurer's Office, from RVK directly, through a shared performance reporting platform referred to throughout our presentation as Paris. And also through multiple follow-up conversations with RVK. They have several spreadsheets and other internal calculations that are utilized, particularly in the incentive compensation space. And they're very generous with their time and with their responses to our questions. So we had the opportunity to interview folks from both RVK, from the State Treasurer's Office. And again, ultimately, we felt like it was a very collegial process. We got the information we needed in the way that we needed it in a timely fashion, which was great because this was a relatively consolidated timeline. And importantly, when I think about the various components of this review, and we'll walk through it in order. So I'm speaking a bit about the methods now. If you look at page 6, you can see a summary of our observations throughout the program. And what we'll do is briefly have Nick walk through our benchmark review and provide our comments and thoughts there. Sue will walk through our performance methodology, audit, and review, and then I'll finish up with our review of the incentive compensation and kind of our analysis of the broader marketplace there. So understanding that a lot of time and energy has been put into both of these programs over the years to develop an appropriate structure, and also appreciating that having a second set of eyes on anyone's data, I think you should expect, and any group should expect, that we all come to this with a little bit of a different perspective. I think that Jim highlighted this earlier. So any observations that we have, at least in the context of this particular review, I think come from a place of having an opportunity to look at something that we don't spend all day and every month and quarter looking at the performance of, and coming with a bit of a fresh perspective. I think similarly, RVK did that for the WRS portfolio. So to me, none of the items that we raise are what we'd consider red flags. They're more items for consideration and potential improvement going forward. So if there aren't questions about the structure of the review, I'll turn it over to Nick to walk through our benchmark analysis.
Great. Thank you, Mika, and thank you to the Appropriations Committee. Can everybody hear me there in the room?
Yes.
Yes.
Great. I will organize my comments on the benchmark review that we undertook in three sort of separate areas. I'll talk a little bit about the process we went through. I'll think about some, generally accepted schools of thought about asset class benchmarking. And then finally, I'll just highlight a couple areas where we think may warrant future conversation between the boards that govern the state treasury portfolio and the treasury staff. So first, to just go through the process a little bit, the benchmarks that we reviewed were the asset class benchmarks that are listed publicly in the investment policy statements. And we reviewed the investment policy statements over the past 3 fiscal years. The Wyoming State Treasurer's Office, like many institutional portfolios, utilizes a total fund policy benchmark to assess the performance of the total portfolio over time. And this benchmark is a weighted average of the underlying pool benchmarks. Then within each pool, there is a specific benchmark applied to each asset category. So we'll talk a little bit about the asset class benchmark specifically, but all of those roll up to the total plan benchmark. Now, you heard from the previous presenter here that there's two widely accepted schools of thought within institutional investing about how to determine whether a benchmark for a given asset class is appropriate. We list those later in the document. I'm not going to go through them, but they're called either the Bailey criteria or the CFA Institute, which Jim alluded to, also has a set of criteria as well. These two sets of criteria have some overlapping characteristics and concepts, and one of them is that the benchmark should be investable. It should be possible to replicate and hold the benchmark and earn its return gross of fees. Now, to show how many commonly used asset class benchmarks fail one or more of these criteria, I will also pick on private markets. This can also be applied to a lot of alternative categories that they're not necessarily investable. Private asset classes are comprised of private assets that are just not available for anyone off the street to invest in. And so when institutional portfolios try to benchmark these types of assets, there are two sort of generally accepted ways to do that. One is through institutional quality composite style benchmarks that are made up of similar private market general partnerships. And these come from providers such as Cambridge or Preqin or Burgess. And then another way is to use, say, a public markets equivalent plus a premium. So with private equity, this might be something like the Russell 3000 or the Russell 2000 plus 100 or 200 or 300 basis points. And the problem with both of these benchmark styles is that neither are investable. You can't invest in the private market composite benchmarks, and you can't invest in that premium that you would attach to, say, a Russell 3000 index. So that's just one example. The benchmarks for these areas of institutional portfolios may fail other characteristics, such as being accessible just because the benchmarks often require a licensing fee to access. So, this is an example to offer some testimony that it is critical to understand that many of these commonly used benchmarks fail one or more of these tests, and thus the total fund benchmark, which is made up of many of these asset class benchmarks, will never be really a perfect comparison to an institutional portfolio's diversified asset allocation. So knowing that some of these underlying benchmarks will fail some of these criteria, we really focus on the process of how the benchmarks are selected. We look at things like, was there open, transparent conversation about the different options in each area? Did a third-party consultant concur? Is it publicly listed in investment policy statements? And is there a simpler approach? And even following this sort of an open, transparent process like this, you may still not have the perfect or the right benchmark for each area. In our review, we found that a collaborative approach to benchmark selection was utilized, with the consultant, the staff, the various boards having the opportunity to review any asset class level changes. And we're satisfied that the differing opinions voiced by various parties were considered when presenting final recommendations. We also summarized some of our findings on some of the individual asset class benchmarks, but just at the very highest level, based on our assessment, we did not find any demonstrated likelihood of ability to manipulate outcomes in the reporting of performance data with the third-party consultant responsible for reporting, as well as the recommended benchmarks. We feel the risk here was reduced to the lowest possible level. We do have a couple recommendations on page 6 here, and I'll go through just a couple of these. And these are really just recommendations for future conversation, right? We go through every asset class later in the document, but page 6 will have kind of a couple that we'll key in on. So the first one here is real estate. Within the state treasury portfolio, we have core real estate, and then we also have non-core real estate. And both of these areas are benchmarked to the NCREIF Odyssey benchmark, which is a core private real estate benchmark. When we think about core real estate properties, are typically fully leased, they have stable income. You have a good idea of the income levels you should get going forward. When we think about non-core real estate, these are typically buildings in need of some sort of renovation or all the way up to sort of development opportunities. And we attach criteria or an assessment of these funds as being either value added or opportunistic. And so both of these areas, core and non-core, are benchmarked to the same benchmark, but non-core real estate typically comes with higher risk and higher return expectations than core. So in that area, we think that maybe, this may warrant a conversation going forward on, is the NCREIF Odyssey the best benchmark to utilize for the non-core real estate section of the portfolio? The other area that we highlight on page 6 is private infrastructure. So we think about infrastructure, it's typically used in institutional portfolios for diversification, for inflation protection, for stability of income. Underlying investments can be things like airports or ports or data centers, toll roads, and the vehicles that are used to access infrastructure are typically something that's similar to core private real estate. And so for the state treasury office portfolio, they utilize, a less common benchmark, which is the 10-year treasury yield plus 350 basis points. And while this isn't common, we do believe it's reasonable, because when you think about the inflation protection aspects of infrastructure, when inflation kicks up and increases, you would expect treasury yields to also increase. So in theory, they should move in the same direction. But that said, it is less common. We think that this is an area that may warrant further conversation. And the other characteristic about treasury yields is they typically won't go negative, especially if you add 350 basis points onto that. And really, with any institutional investment, if you're taking risk to get a positive return, you would expect some negative returns, and some depending on the market environment. So just wanted to make sure I highlighted those two areas. The rest of the asset classes, there really wasn't much to report. We found them all the benchmarks used there are very reasonable, and thought that this was a good process to go through, and certainly interesting for us. I'll pause there for questions. Otherwise, I can turn it over to Sue.
Okay, please proceed.
Sue?
Great, thanks. I'm going to skip ahead to page 47. So Karen, if you don't mind fast forwarding for me, that would be great. Thank you.
Please. Yeah, floor is
All
yours.
right. Thank you. Can everybody hear me okay?
Yes.
Okay, great. So as we all know, Makita was contracted to review the reported investment performance for the fiscal years 2021 and 2022. So to do this, as part of our scope, we reviewed the Paris data directly through the Paris technology and used that for our review. And as Mika mentioned, both Makita and RVK use the same performance reporting technology. So it was relatively easy for us to share data with each other, and it was readily available for us to review. So to start, for the years requested, we looked at the methodologies used by RVK, including the performance calculations on the individual investments at each rolled up asset class level and at the total fund level. We validated the data that was used in the calculations. As we've been all talking about, the integrity of the data is crucial for performance reporting. We tied that back to custody bank statements and manager statements, and we reviewed the policy and custom benchmarks. So first, focusing on the methodologies, Makita found that RVK uses methodologies that are consistent with industry standards. They use what's called a modified Deets calculation for their public market managers. They use the modified Deets roll-up for total fund and for asset class levels, and they enter market values after every cash flow, which really mitigates the impact of significant cash flows. Again, all of these practices are widely used in the industry. While the methodologies they've used are consistent and acceptable with industry standards, we did note several observations of RVK's work. So first, the modified Deets performance calculation to roll up returns. Well, that's a little bit different than what Makita uses. Makita uses a weighted average roll up. It's perfectly acceptable industry practice. And at the end of the day, both methods really result in similar returns in the absence of significant cash flows. However, this might require a little bit of further review. The technology Paris has a couple weaknesses when you're rolling out modified Deets calculations when you do have significant cash flows. So it might be worth having a further look at that methodology. Second, RVK doesn't employ a large cash flow policy, meaning that when there's a cash flow greater than a certain percent of assets that occurs, an analyst is required to enter what's called an interim market value. Makita has a cash flow policy of 10%, which seems kind of industry standard, working with, with outside auditors to help us figure that out. It looks like RVK doesn't have a large cash flow policy, enters interim market values for all of their cash flows, which could be unnecessary when some of those cash flows are smaller numbers. It could just result in unnecessary work. So again, something worth reviewing. And then finally, Makita observed some minor discrepancies in some index calculations. However, we dug into these and subsequently reconciled these and validated they're mostly due to underlying constituent level data. So the Paris data vendors send in updated data later down the road. They might send preliminary and final, and which is not an uncommon occurrence. That happens quite frequently. Karen, if you could flip forward to page 52. The second part of our review really dealt with reviewing the data. So we reviewed all the data related to the performance calculations for fiscal year 2023. We randomly selected a subset of the data. We selected about 25% of the managers on the roster, making sure we chose some from every single asset class. We gathered all the statements from RVK, reviewing all the statements, about 28 statements from each month. So we looked at about 84 statements, which is quite a lot. We reviewed all of the data from those statements, including market values, cash flows, returns, all of that data. And we were able to corroborate that and tie that back to the Paris reporting platform and tie that back to the actual reports that were presented. So at the end of the day, we felt that RVK is following protocol of accepted performance, return calculations, and data aggregation. With that, unless there are any questions, Mika, I'll pass it back to you.
Great, thanks, Sue. So we'll move on to the final portion of the review, which is really related to the incentive compensation program itself. And this work really begins on page 65. And I'll just make a couple macro comments about the work that we did here and then discuss some potential observations or recommendations for consideration. So in terms of reviewing the data, I did want to highlight there is one difference between the State Treasurer's Office, there's two differences, excuse me, between the State Treasurer's Office incentive compensation plan and the Wyoming retirement system. The first difference is that the state treasurer's office plan includes total fund level performance, that's 50% of the calculation, and then 50% of the calculation is asset class level performance. So only each investment staff member who works on those specific asset classes is eligible for the performance compensation in that asset class. So that's one difference. The second difference is that this pool of assets also has some statutory limitations on the investments that are included and are available to be included in the incentive compensation program. There are also some other components of the assets that are excluded, either due to the time frame within which they're invested, which don't apply to the current staff, or for other reasons. And so I just wanted to highlight that what this means in practice is that when you're taking a look at the publicly available performance for the state of Wyoming's portfolio here, which is very accessible, there is a second layer of performance that has to be calculated by RVK in order to feed into that incentive calculation. And so Makita reviewed, as Sue went through, all of the traditional investment performance reporting standards and output through Paris and what's available in the public reports. And then secondarily, our team reviewed that work that RVK does to reanalyze the performance. There are also some time period differences due to the rebalancing that's required within this program. And so what this means is that at the end of the day, the numbers that you see in the standard reports may be slightly different than the numbers that are used in incentive compensation. So for us, this meant that we wanted to take the time to dig into those numbers and make sure that we could corroborate the processes used. And ultimately, we were able to corroborate all of the market values, and we were, through conversations with RVK, able to corroborate all of the calculations and structures in place to measure performance compensation for this program. I will note that in a few instances, none of which we believe to be material, we were unable to match exact numbers because a lot of individual data sets are comprised into an asset class performance, for example. And so because those historical data sets, again, as I mentioned, don't exist in Paris, it creates a trail where we weren't able to perfectly replicate every single underlying number, but we were able to, through those market value reviews, through the additional analysis and calculations, feel very comfortable that the performance as reported was accurate. So with that as the backdrop, we had a couple of comments about the incentive compensation program broadly, and I'll maybe go to page 70 for a moment on my way to those, just to highlight that there's a few ways to approach incentive compensation in the industry. I think Jim did a nice job of highlighting how widely it's utilized today, both in the private sector as well as the public sector. We've seen it only grow. I've been here for 21 years, and every year more and more public funds in particular have added incentive compensation programs, I think, to solve for the same challenges that the state of Wyoming has faced historically with turnover and with a desire for very strong performance over time. But they each approach it a little bit differently. So the three broad approaches are to not use incentive compensation. The only places where I've seen this method be successful in the public sector is when a private sector peer index approach is utilized. The state of Washington is one example of this. They do not do incentive compensation, but they pay their employees at least median at the level that they would be paid in the private sector. That's a lot of money, and a lot of state systems have not been comfortable going to a flat fee where you're paying not knowing if the performance will be good, bad, or indifferent, right? You're just paying a much higher flat rate for your employees. So that's one approach. The other two, the state of Wyoming uses in combination today. So asset class-based incentives are typically used to help motivate employees who are doing the work in a particular asset category. It results in a lot of attention to that asset category, and I think a lot of ownership of the results in an individual asset class. But some of the cons include, in some cases, not in every case, but it can create a competitive atmosphere where there's always going to be some cyclicality of returns. And when you have people kind of fighting for wanting to be part of that asset class team that is having a winning 3-year cycle, in this case, it can result in some challenging discussions for some programs. I'll also note that this is particularly obvious when you think about public markets versus private markets. Because whether your private markets are outperforming their benchmark or underperforming, it tends to be persistent over a longer period because of the nature of smoothed returns in private markets. So if I'm a public equity analyst, I'm either underperforming or outperforming, say, the MSCI ACWI. Everybody can look that up. The NAV is available in real time. It's very easy to calculate. If I'm helping to manage a private equity portfolio, I have the benefit of only quarterly updates to NAV, cash flows, and then really only an annual audit that's required by a lot of those firms. So my performance incentive might look really good for a long period, and then maybe it's underperforming also for a long period. So just one thing to keep in mind, which leads me to Makita's broad preference, is that total fund-based incentive compensation allows an overall program to reward the performance of all of those asset classes in aggregate to outperform a collective benchmark. Now, there are obviously cons with every approach, and this one is no different. One of the challenges here is that you may not have all employees contributing equally to the success of the program, and there's no way to differentiate in this structure from one employee working in an asset class providing a lot of value and another employee maybe not providing as much value. There are other ways to think about that with qualitative components, et cetera, but I just wanted to highlight it as one of the challenges with a total fund-based approach. On page 72, this is the last page that I'll cover and the last recommendation from Makita for your consideration. One thing that I do feel strongly about, and I believe that I heard concurrence from Jim and RVK on this when looking at the WRS program as well, as these programs have matured and you now have not just 3 years of results, but you're all the way through 4 years and now working on the 5th year of performance, anytime you can extend the period of look back for performance compensation, I think that you're then rewarding employees for the good work that's done over the long term, right? Because the reality is you don't want people to just outperform 1 year and then underperform for a year and then outperform for a year. You really want to see consistency. So anytime you can extend that look back to 5 years, I think it's well worth the energy to do so. And then the only other thing that I will note, there is a cap on alpha that's available for each of these incentive compensation programs. And I only bring it up, I don't think it's worth spending a ton of time on today, but just for future consideration, that type of a cap, it's worked well here. You are well under that cap in terms of what has been paid out to employees for the state. But I would note that it really only works when you have a very large asset pool, right? If you're 10 billion in the case of Wyoming Retirement System, or you're 30 billion in the case of the Treasury, you have a big asset base. So 2% of alpha, it can be a meaningful amount, and you have investment staff here that are relatively modest in size. But if you were, say, a $1 billion endowment, even with very strong performance, it might be more challenging, right, to spread that around. So I just note that it works quite well in this structure, but part of me wonders if it's adding a complication that may not be necessary given the size of the programs. And with that, I'll conclude, and we're happy to take any questions from the committee.
Any questions for Mika?
Too scared to have a question.
Go ahead, Bill.
It's kind of a random question. What is a Deets, a modified Deets performance calculation?
It's great. It's the one page we cut out of our presentation today in the interest of time. So I appreciate Sue will be happy to walk you through the differences between modified Deets. Go ahead, Sue.
It's basically a very simple basic performance calculation. It takes if you think about typical performance, your ending market value minus your beginning, it gets you your difference divided by your beginning, right? Modified Deets is really taking into consideration a weighted cash flow. So if you got a cash flow like midway through the month, it's going to weight that because you didn't have access to that cash for the entire month. You only had it for half of the month. So that's what the modified Deets does. It takes into consideration cash flows.
Gotcha. Okay, thanks.
Okay, any further questions? Seeing none, well, thank you very much. We appreciate your time and effort.
Thank you all.
Patrick, you got a couple comments? Where's your costume?
He's wearing it.
Dawn allowed us to wear jeans today, so. Jeans.
Yeah, yeah.
Mr. Chair, members of the committee, I'm Patrick Fleming, CIO for the Treasurer's Office. And I apologize for those of you that were in CapFin, and I'm going to go over the same thing I did yesterday, but for those of you that weren't, I just want to continue to comment. And I've discussed this before, but the bottom line that Makita put through in this very thorough overview was, based on the review, there was no ability, they did not see any ability to manipulate the returns and performance, which, we know is true. And so, as I've stated before, our total, if you look at our salaries and performance compensation for the 10 individuals, it was slightly over $3 million. And if you look at June 30's alpha performance, the return above the benchmark, we outperformed the total fund by 150 basis points on $30 billion. 30 by 150, that's $450 million. So I have said this before, but if you told me that I could invest $3 million and get back $450 million, that is the single best investment I can think of. Or as the treasurer loves to say, you're talking about, close to 110 or 120 years of pay to make up for that difference in the alpha. And that's really what we focus on. So we have this performance compensation plan, and if you read it, they said over the last 3 years or 4 years that we produced 601 million or what have you. But there's many asset groups that are excluded from the performance compensation, which we still focus on. We still want to produce the alpha. It doesn't matter whether we get paid on it or not. So we really focus on that. So, overall, Makita did a great job, as I said, and showed, there wasn't anything different. But the one thing that I do want to highlight is I'm really glad we did this because they did bring out some points, and one of them that we missed that I do want to highlight. So some of the big components that they talked about was the rolling average number or what have you. If you can smooth that out, completely agree now that we have a much more mature fund. If you could have a rolling period, it smooths out the returns and is better. No question on that. They did comment on some of the preferreds. We've no longer have a preferred index, and we have liquidated that fund, so preferreds are no longer in there, so that part you can strike. The one point that they did bring out is the Odyssey fund for real estate. So the Odyssey is the benchmark for core real estate, and it's just comprised of your retail, commercial, industrial, multifamily, et cetera. The four components. It's like the S&P benchmark of equities. And they said, well, we have a core and a non-core index, and the non-core is comprised of much more volatile instruments. So the Odyssey has an average leverage of about 1.25 times. But the non-core can have an average leverage about 1.6 times. So one, it's a higher yielding instrument, and it's more risky. And in our performance, we only did the Odyssey. And we need to correct that. So that will be corrected. Now, if we were trying to game the system, it's de minimis. It's not really, that big of a deal, but it still is not correct because, we're getting paid for alpha, and yet it's just a beta play. By doing that, you're just getting paid, and that it's not correct. So that is an oversight on our part, and we will correct it. I was asked yesterday the question, it's like, well, did you take advantage of this? And our index, we should be at $1 billion, and we're only 600 million. So Robin Preston, who manages it, has been underweight the index. So if we were trying to take advantage of the system, we would have added a heck of a lot more in the non-core, But with real estate being down, we outperformed the index by being underweight. So it's something that worked out for the fund, even though we don't get paid for it, but we don't care. That's something that we focus on. But our plan is to take Makita statements, and during our annual asset allocation, we're going to bring them to the IFC, and we're going to talk about anything that needs to be adjusted. The other one that they brought up was infrastructure. So our benchmark is 10 years, 10-year treasuries, which are approximately 4.25%, 4.3% this morning, plus 350 basis points. When they proposed this benchmark, I fought hard not to get it because, as we know, US 10-year treasuries rarely, I don't see a situation of them ever going below zero, plus 350. So the benchmark is always going to be positive. And I promise you, the infrastructure fund will not always be positive. So it's a mismatch between the two, but it was kind of like, well, we really don't have, there's a Cambridge and all these different ones, but I would love to change this benchmark. But I was voted down and they were just saying, no, let's just do simplistic terms. So it is what it is on that one. And then the opportunistic one, going to a 60-40 or something, we really don't care. That was just one of the IFC members that just said, well, if you're going to take the assets out of one of the asset classes and invest in an opportunistic fund, then you should have, your benchmark should be the total return of the fund. And so we're like, fine, whatever you want. So I just want to give you a background from the Makita's statements about one, why, and I still, I'm very vociferously saying that this is an unbelievable investment for the state. And two, I think it's a great framework. It keeps employees. Everyone's on their toes, as Mika was talking about, where you're really focusing on your asset class. So 50% is on yours and 50% is on the fund, which then keeps you engaged in the total fund. And so whether it's you or other people you're trying to help, I just think that's a really great way to do it. And three, we're always trying to make it better. So we're really working on trying to do what we have, trying to make it better, and do what we can do. We've always talked about having, the other staff members be part of it or whatever. As you know, that it's been an ongoing thing with Treasurer Gordon and so forth, so I'm not going to comment on that one, but that was, as you know, something that's always been said that we would enjoy, but it is what it is. So with that, I'll stand for any questions.
Questions for Patrick? Oh, thank you. So rumor has it you're giving a notice for, when's your, June, is that right?
Mr. Chairman, yes, till June. So speaking with the treasurer and seeing some of the things that we can do, working with Don, we're just drawing up an RFP right now for a new CIO, looking for headhunters to be able to do that. Hopefully I'll be able to help with the treasurer and the generational fund that he's being able to push for, work with the group that we have in finding a CIO who wants to continue with some of the things that we've started. About a third of our fund is managed internally, so someone who has active management and understanding of managing internal investments, and be able to take it to the next level. And so that's something that I'm hoping for. If you said, you leave early and you have somebody, who has kids, they're not going to want to leave in the middle of the year and so forth. So hopefully by June, they'll be able to be out of school, or if it's someone internally, it would be easy, but, so we're just going to open it up and really look for the best candidate. We've already been approached by 3 individuals, highly qualified individuals. I don't want to share their name, but 2 of the 3 we know. And it's, I think we're going to get a great group of people that will apply for this job. And
It'll be one darn high bar to meet.
well, thank you, but everyone is replaceable. And we're just looking for someone that really is going to be able to do what we want to do, because I will really miss working with all of you and what we have achieved. I am really proud of what we've done. not, the three-legged stool between the SLIB and IFC and all of you, what we've achieved. We've gone from 19 to 30 billion. We've distributed almost 5 billion. We have done a heck of a lot from over the last 10 years. So, kudos to all of you as well. So it's been, a great team effort. And we were talking at the Wyoming Taxpayers Association with Representative Larson or Walters and Senator Nethercott, and just saying how this isn't normal. This relationship that we have is not normal. Many states don't have this relationship with the legislature and the SLIB and the governors. It's fighting. But, with all of you and what we've done, I'm just very happy and appreciative of your effort and backing. So I want to thank you.
Well, we're going to make sure to get a hell of a lot of work out you between now and June.
The treasurer and Don's already taken care of that. Well, thank you.
All right, any other questions? All right, thank you very much. Anything else on this particular subject? Any public comment on the performance compensation? Go ahead.
Yeah, Mr. Chairman, just one note. There was discussion earlier about using a geometric average versus an arithmetic average. That would require a change to statute. Both performance compensation statutes specify that the arithmetic average has to be used. So just wanted to note that for the committee's consideration.
And Patrick, any comments on if it makes any difference or?
Again, the modified Deets, it just takes into this smoothing process, which is better. So unlike having, the seesaw, by smoothing it, it's just a better way to make sure, because there's no question, we've had two individuals who haven't met performance compensation standards, who haven't been part of it because of this, and it is what it is. But it's not like we always make our bogey. But by doing this, it would help to try and smooth that.
Okay, appreciate it.
Thank you.
Don? I think. Well, yeah, let's take a.
Let's let people know where we're going to go, though. We are going to move technology replacement to tomorrow morning. And after a 10-minute break, we will pick up on state construction 25 LSO 0064. So it is 3:24. Let's be back here at 3:40. Let's round up our troops. Troops are slow to respond. Ready? Let's go ahead and get her started. Tamara, welcome. We have a bit of legislation we've worked repeatedly, and then we think it may be ready for prime time. So if you'll walk us through 25 LSO 0064, Public Property and Buildings Amendments.
Thank you, Mr. Chairman. Tamara Revley with the Legislative Service Office here. I do want to make sure everyone is on working draft version 0.6. This was updated very recently. Prior to that, a version 0.5 was sent out and was posted online. So please make sure for purposes of line and page numbers, you're on version 0.6. Okay, and if everyone's good with their version, then I can provide you a fairly high-level overview, and then we can proceed to work the bill as you would like. For context, the Joint Appropriations Committee had sponsored 24 LSO or House Bill 75. It did not pass the Senate third reading. So this Joint Appropriations Committee, as part of their interim topics, asked that that bill be resurrected with some tweaks. And those changes were directed by Representative Larson and members of the committee working with the stakeholders involved. The committee then reviewed at least a high-level version of this bill. That was the version 0.5 in September, and now you have before you 0.6. So I'll go through again what the bill does. It affects capital construction, including major maintenance, routine maintenance, and strategic planning, and also to some extent public works, just for purposes of resident contractors and contracting. Who this bill affects are state agencies, those state-owned buildings and facilities under the jurisdiction of the State Construction Department and the State Building Commission, the University of Wyoming, the community colleges, the school districts, and then I'll add in there the caveat, other public entities, including all other public entities, but just with respect to resident contracting. There are four major categories of subjects addressed by this bill, and I'll go through those four. The first is to codify provisions in the budget bill that relate to major maintenance, ensure that major maintenance funds do not revert automatically at the end of each biennium, to codify the use of the major maintenance formula, and to codify the reporting requirements that are typically found in your budget bill, section 308. The second major category of things this budget bill or this bill affects is to use consistent terminology to make uniform the definitions. And it does that by consolidating and standardizing definitions for key terms like major maintenance and capital construction project and capital renewal and renovation, routine maintenance and property across all those affected entities that were the who of this bill. Then the third thing is it brings in this concept of major maintenance requirements, more so than is in existing law at least. It would require entities to develop and implement proactive maintenance schedules, and that includes planning and record keeping, and it would require agencies and entities to focus on preventing maintenance backlogs and ensure their properties and components reach their full life expectancy. And then the final category within this bill is a little bit of a catch-all, and these are policy updates that are directed by the legislature. It would eliminate the phase-in for community colleges for major maintenance. There was a 7-year phase-in for major maintenance funding when a new community college building comes on, and it would eliminate that, which is consistent with existing practice. Then it would make changes to contracting for public works, and just in a very limited place for non-resident contractors. Then it would introduce this concept of supplemental funding for big, kind of high-level major maintenance requests when allocated funds are inadequate for repairs. And then finally, it would introduce statewide strategic planning, which you've heard a lot about this interim from the State Construction Department. It's a little piece of this bill that would formally bring that in and make that a requirement in law. So with that, the bill's rather long. A lot of that relates to conforming, the terminology, and if there's no other questions or comments at this point, we can jump right in. All right. So the first part of this bill is a create. It relates to the University of Wyoming, and it sort of shows you what the structure for all the agencies that are affected in this bill are going to be. You see on page 2, these terminology or definitions that point to the State Construction Department statutes for one place where these terms are all defined, wherein then all the other entities that reference these terms and statutes that reference these terms point back to the same place. So when we get to the State Construction Department statutes, you'll see what these definitions mean for capital construction and major maintenance and property and routine maintenance. On page 3 is a new subsection B, which requires the University of Wyoming to develop a prioritized list of capital construction projects similar to the way community college statutes read. Subsection C would require, would codify the major maintenance requirements that are in the budget bill for the university and for the other entities, and direct use of the major maintenance formula, and then require that report to the Joint Appropriations Committee or to the State Construction Department. On page 4 are the provisions, and these will be very similar for the other entities affected, for school districts and for community colleges and state agencies. These are generally the routine maintenance requirements and the major maintenance anticipated funding requirements. So subsection D1 is to develop schedules for routine maintenance. D2, Romanet 2, is to anticipate and plan for funding for major maintenance requirements that are going to come up. And D, Romanet 3, is record keeping for routine maintenance work. You'll see similar text as was just on page 4 for the other entities when we get there to where they occur in statute. These are in order of, that was the section 1 create. Now we're going to move on to section 2, which is amend. It begins on page 5. And the first statutes that are amended are the state construction departments. The first changes are these definitions that will now be consistent for all the entities involved. There's the definition of capital construction project, capital renewal, major building and facility repair and replacement. And that's on page 7. I should tell you that this is mostly based on the existing definitions in statute. It sort of takes all of the definitions and brings them all together and conforms them and makes it a little bit broader to work for all the different types of entities and facilities involved. But the model of it is existing law, plus all the tweaks directed by the legislature and individual members of the legislature as we worked this bill. So that definition of major maintenance or major building and facility repair and replacement continues for several pages, starts on page 7, continues on page 8 and 9, and finishes up on page 10. Next, you have a new definition of property. The word property is used throughout the definition, so it is defined. You have a definition of renovation. Renovation is a word that's used in statute, but it wasn't previously defined. So in order to understand what that term means when it's used, it's defined here. There's a new definition of routine maintenance. It is an existing statute that was pulled in and moved and just tweaked a little bit. And those are your major definitions or terminology that's used throughout the bill. On page 11, we jump into the State Construction Department statutes, and most of these changes are to conform terminology. Then on page 12, The top of page 12, paragraph X, 10, and 11, these are to codify, or paragraph 10 is to codify the major maintenance formula that would now be used, or would now be directed to be used in statute for state property, community college property, and University of Wyoming property. Paragraph 11 on lines 10 through 13 is a clarification or a duty of the State Construction Department to approve and review any renovation that changes the intended capacity or designed intended use that receives major maintenance funds. On the bottom of page 12 is a very big concept that's been talked about this year, and that's the strategic planning. It's a fairly small change to statute, just one new paragraph. Starts on line 22 and continues to line 25, and just directs the State Construction Department to develop and maintain a 20-year statewide strategic facility plan and comprehensive system for monitoring and reporting appropriations and expenditures for CapCon and routine maintenance for state property, community college property, and University of Wyoming property. Then on page 13, continue some terminology changes on lines 10 and 11. And on the bottom of page 13 is to codify the provision in your budget bills in section 308 that say that major maintenance funds that are appropriated shall not revert, and they can be used for other major maintenance projects. This codifies those within the statutes that relate to the reversion of funds and adds major maintenance funds to a list of other funds that do not revert unless the legislature otherwise say they should revert. Then I do have a staff comment on page 14. There was some discussion at the June meeting actually about what about the buildings that are not under the control of the State Building Commission, that are, for example, YDOT or Game and Fish buildings that fall under the exception that's in statute, where if statute assigns management and use of a building, then the rules generally that are promulgated by the State Building Commission do not generally apply, although they can, of course, use them. And what do you do with those buildings with respect to major maintenance and ensuring that there's some oversight? And so I have one suggestion. It's kind of a beginning and attempt at, if you would like to bring those in, but not bring them in completely, you could perhaps, here where we are amending 95105, you could address those buildings that are not under the SBC's jurisdiction and just ask that their plans to construct, renovate, or lease or purchase has been submitted to the State Building Commission for review. There's a lot of other different policy directives you could make with that change, but that was kind of a base attempt at bringing them in response to the committee's request. Then continuing on to page 15 are changes to the SBC statutes to, for state buildings to bring in those requirements for the routine maintenance schedules and for planning for funding for major maintenance. And on page 16 for record keeping of routine maintenance. On page 16, subsection G is to codify the major maintenance formula. In existing statute, it just applies to community colleges, and each budget you go in and say, for the other property, use the same formula as is used for community colleges. Well, this amendment would just broaden that, so statute actually directs use of the major maintenance formula for state property, community college property, and University of Wyoming property. On page 17, we continue to codify what's in the budget bill, and that's the reporting requirements. And then subsection K on the bottom of page 17 is this new concept of allowing for supplemental major maintenance funding requests when what's appropriated for major maintenance based on formulas are insufficient for some kind of a repair, replacement, or an upgrade that's going to be needed in an agency or the University of Wyoming. This would let them identify those and request them specifically. Finally, I guess we're not finally yet. We still have a bit to go on page 18. More changes to terminology and conforming. Same thing on the bottom of page 18 and the top of page 19. Page 19 contains that somewhat specific change that affects all public entities when they contract for public works. And public works are generally capital construction type of things. It's a broad category of work, but it is generally those things that public entities like states, agencies, colleges, local governments, all of those things that are broadly defined as public entities in these statutes. This would change contracting if advertisement for bids or requests for proposal is not required, which means that the public work is estimated to be less than $50,000. Generally, the contract needs to be let to a resident. Well, this comes in and makes an exception, provided that if the services required are not offered by any known resident, the public entity may let the contract to a non-resident. And on page 20 is another change to contracting, where if an emergency arises, a public entity may waive the requirements of this section. So continuing on page 20 are changes to terminology to conform those definitions. That continues on page 21 and page 22, which we move into school districts, K-12 school districts. On page 23, page 24, page 25. Those continue to change terminology and to conform provisions. On page 26 is to codify what's in the budget bill with respect to reporting. To clarify, the report goes to the Joint Appropriations Committee on major maintenance expenditures. Continuing on to page 27 are changes to update and conform terminology. Same thing on page 28. And then on to page 30 is the planning for routine maintenance, developing proactive schedules, anticipating funding for major maintenance, and establishing requirements for record keeping. On 31 is that change allowing for supplemental budget requests. Bottom of page 31 all the way through 32 is to envision that supplemental budget requests for major maintenance could be allowed, provided that a school district would be required to expend not more than 50% of the projected balance of their separate account for major maintenance building and facility repair. On page 32 and 33 begins more terminology conformance. That continues on 34 and 35, which we begin jumping into the community college statutes, continues on page 36. On the bottom of page 36 is codifying, I think, that reference to the major maintenance formula and the report on expenditures for major maintenance. On page 38 are those requirements for routine maintenance, for the schedules, for anticipating major maintenance funding requirements, and for routine maintenance record keeping. Then 39, we have more terminology changes. That continues on 40 and 41, and 42, and 43. On 43, you have a section 3, which is a repeal section. The first two statutes or subsections or subparagraphs that are repealed are definitions, and then the third one is the 7-year phase-in for community college major maintenance funding. And in that staff comment, you can read the text of the repealed language. Section 4 is a direction to promulgate rules for the State Building Commission, the Community College Commission, and school facilities, and for the University of Wyoming to promulgate regulations. Section 5 are some exceptions that were added by amendment when this was House Bill 74. And Section 6 is the effective date, which is generally July 1st, 2025, except that the rules and regulations could begin to be promulgated. So that's a page-by-page walkthrough of the bill for, I'm not sure how many times you've had that.
But well done, thank you. All right. Pardon? Move the bill. Second? Moved and seconded. Discussion? Do we want to move to public comment before we vote? Let's take public comment on the bill. Any comment from the public on the bill? All right. Oh, here we go. Please. Welcome.
Mr. Chairman, members of the committee, for the sake of timing, my name is Kelly Little. I'm with the Associated General Contractors of Wyoming. I just wanted to say that we are in favor of this bill. Anything that clarifies and makes things consistent throughout statute helps my members, operate within the law as they do these projects for the state. I will say the part about the non-resident contractor being allowed to contract out of state when there's not somebody in state to do a project, or if there's an emergency, we are okay with that language, but that is as far as we would like that to go. We'd like to be able to keep those resident contractors working in the state of Wyoming as much as possible. Other than that, I just want to say we support the bill, and I will stand for any questions.
Questions for Ms. Little? None? Thank you.
Thank you.
Thank you so much. Further public comment? Further public comment? Public comment is closed. To the committee, any discussion? If not, let's call the roll.
Members of the committee, the motion is on LSO 0064 Working Draft 0.6. Representative Henderson. Aye. Representative Larson.
Aye.
Representative Sherwood.
Aye.
Representative Stith.
Aye.
Representative Walters.
Aye.
Representative Swanisser Dave.
Aye.
Senator Anderson.
Aye.
Senator Guru.
Aye.
Senator Salazar.
Aye.
Senator Nethercott. Aye. Co-Chairman Nicholas. Aye. Co-Chairman Kinski.
Aye.
Mr. Chairman, the motion is approved. House bill or Senate file?
House. It's too complicated for the Senate. Do you want to go ahead and try and get into TERP? Bob, we got done a little early. Do you want to go ahead and hit the technology replacement program?
Mr. Chairman, unfortunately, they were sent
they
back to
bailed out.
their offices, and
Okay.
they will be here at 8 a.m. Tomorrow.
All right. Yeah, no, that's true. It is Halloween. I forgot. I don't have little ones at home. That's right. Well, what do we have, Don, to your notes for the end of the day before we convene tomorrow morning at 8?
Mr. Chairman, members of the committee, you received the October 2024 Craig report. You received a presentation of the results of the shooting task force. I understood the committee's direction to add them, and particularly the consultant from Northern Wyoming, to the December agenda. You also requested some additional materials related to that project. You received a report on Section 321, which is the Budget Management System Review, including recommendation.
Before you go, Dell, we would actually like to have your office get involved in this. There are, I don't know if you overheard, but if we can get the design of the one down in, I think it's Colorado Springs? Grand Junction. Right. And so what we'd like to do is if we can get the floor plans that they have, and then have you do a rough estimate, a cost evaluation on it, so we can know what the cost to construct it would be, in generalities, and if that would be very useful for us as we consider and how we're going to move forward with it, whether it's going to be a bill versus a budget amendment, and just I just think it'd be of value to all of us, so.
Mr. Chairman,
Yes.
that is the Cameo Shooting Complex is the name of it in Colorado.
Okay.
CAMEO.
Thank you, Mr. Chairman. Del McComey, Director for State Construction Department, will work with your LSO staff and get that for you. What was the date you would try to get that by? Is for our meeting that we'd have scheduled in December?
The week of December 9th.
Okay. Okay, thank you, Mr. Chairman.
All right. Anything else, Don?
Mr. Chairman, you received that Section 321 report from the SAO, their contractor, and supplemental comment by the State Building Department, LSO, and the current software provider. You received a report from RVK as well as Makita on the performance compensation plans of the WRS and STO. And then you recently approved LSO 64, Working Draft 06 on public property. Tomorrow, you have moved first on the agenda a explanation from the CIO on the technology replacement program. I expect that might last only 15 or 20 minutes. You'll be slightly delayed in your opportunity to respond and to provide a recommendation to the governor on an external cost adjustment for K-12, the ECA. Then you'll receive a update on employee compensation from the Department of Administration and Information. You'll recall there is approximately $9 million of general funds provided and a proportionate amount of other funds for this biennial compensation increase, and Director Bach, I believe, will be providing that. After a short break, we'll have a number of agency follow-ups, and these were requested early in the interim. There's an update on the endangered species and the funding available to that. That provision, you may recall, was vetoed by the governor. You'll receive an update from the Community College Commission and the Department of Family Services on the eKids program, and then a update from the University of Wyoming on the Center for Innovation for Flow through Porous Media. You'll recall you toured that facility in your, I believe it was the June meeting. And then finally, in the afternoon, we have a suite of bills regarding gaming. I believe there's 7 bills regarding gaming, and we'll conclude with a short presentation of data visualization, which was discussed a little bit this morning regarding putting our data book materials online and allowing the members of the public to select the data that they are interested in regarding their community or school district.
Okay. Don, we added something to the week of December 9 today, and previously there have been some other ads. When we're done tomorrow, maybe you could, next week sometime early, send myself and co-chair what you think we've got stacked up for week of December 9. I want to make sure we're not outrunning our headlights there. And
absolutely, Mr. Chairman. And from the governor's office and the state budget department, earlier today, we actually received what we believe to be the final list of agencies with supplemental requests. In addition, we did receive a day early the supplemental budget request from the judiciary. We're in the process of bookmarking that, and we'll be posting it on JAC SharePoint and emailing you as soon as we finish.
thank you. Vice Chair Larson.
Mr. Chairman, I would wondering if it might be possible that based on Brian's comments on the compensation stuff with the treasurer and that to where we needed to change the statute in order to allow is it geometric?
On the modified deeds.
On the modified deeds, if we could maybe just have them draft a copy of a bill that we could look at late when we come back in December.
Our Brian.
Yeah.
Yep. That's probably a 15-minute job to do that. I think it's just changing a few words. So I was.
Yeah, no, I think it's a good idea to take a look at it. That's one more ad for December, but I think we need to take a look at it.
Formulate a smoothing effect.
No, I think it's a good idea. Yeah, let's take a look at it.
Okay.
All right. Well, happy Halloween and have fun trick-or-treating, everybody.
Boo.